Picture this. You're sipping your morning coffee, scrolling through the usual financial updates, and there it is, splashed across every screen. Silver has done it. It's hit a record. The price is dancing around $95 an ounce. There's a palpable buzz, a sense of victory for those who have held on through the years of being told they were wrong. It feels like a moment of validation, a final confirmation that the long-awaited shift is here. And it is important, don't get me wrong. But what if I told you that while this celebratory fireworks display is capturing everyone's attention, something far more consequential is happening in the shadows? There's another metal, one that doesn't inspire poetic talk of monetary safety or ancient stores of value, that is sending a signal so stark it threatens to rewrite the rules of the entire commodities game. That metal is copper, and it's not making parabolic moves. It's just holding. At around $5.89 per pound, it's exhibiting a stability that in this volatile climate is more deafening than any record-breaking spike. This stability is the warning. Because while retail sentiment rockets silver higher on fear and speculation, the titans of the real economy, the companies who don't just trade metal, but whose very survival depends on consuming it, are making moves that tell a completely different story. They are quietly exiting the public marketplace altogether. Amazon Web Services just signed a direct multi-year deal with a mine in Arizona for millions of pounds of copper. Samsung is doing the same. Apple is pouring $500 million into securing rare earth elements. These are not speculative bets by hedge fund managers. These are strategic, defensive maneuvers by corporations who have run the numbers and arrived at a terrifying conclusion. They can no longer trust the traditional exchanges to deliver the physical material they need to exist tomorrow. So ask yourself this. If copper were just another cyclical industrial commodity, why would the world's most sophisticated tech firms be locking in supply at fixed prices years in advance? Why would they willingly pay a premium and tie up capital, rather than simply buying what they need on the open market each quarter, as they have for decades? The screen is shouting about silver's emotional breakout, but the shadow market, the realm of corporate procurement officers and supply chain managers, is whispering a much more alarming truth about copper. If you miss this structural shift because you're glued to the precious metals ticker, you will miss the defining investment story of the next decade. What we are witnessing is the great decoupling. Copper is ceasing to be a commodity you buy when the economy is hot. It is becoming a strategic technology resource, a form of infrastructure oxygen that companies are now forced to hoard. This is my primary thesis, and everything that follows builds upon it. Copper is being fundamentally re-rated from a cyclical industrial metal to a critical bottleneck tech asset. The evidence isn't in the frenzied price action. It's in the desperate, quiet scramble happening off the books. Now, if this perspective resonates with you, if you value analysis that looks beyond the day's euphoric headline to the deeper mechanics at play, then I encourage you to join this community. Subscribing ensures you don't miss the ongoing breakdown of these shifts, as what happens next won't be covered fairly by the mainstream channels obsessed with yesterday's silver high. Let's delve into why copper's boring stability is the most exciting thing on the board. To understand, we must first divorce ourselves from the idea that all metal demand is created equal. Silver and gold are, at their core, fear trades. They are insurance policies bought when trust in the system erodes. I own them. I understand their role. But copper is different. Copper is a consumption trade. It is the indispensable physical input for the two unstoppable megatrends of our age: artificial intelligence and full-scale electrification. This demand is what economists call inelastic. It does not bend or postpone itself because the price went up 10%. A tech giant cannot delay building a data center because copper is expensive. To delay is to cede the AI race to a competitor. An automaker cannot pause its transition to electric vehicles. The capital is already spent. The factories retooled. The demand is locked in by physics and competitive necessity. The numbers are staggering. A single hyperscale AI data center can devour up to 10,000 tons of copper for its wiring, cooling, and power systems. These facilities aren't being built one at a time. They are being constructed by the hundreds globally. Meanwhile, an electric vehicle uses nearly 4 times the copper of a traditional car. We are not talking about marginal growth. We are talking about a step change in global consumption that has already begun, with projections showing demand accelerating for the next 2 decades. This is where my own speculation comes in. my reading of the chessboard. I believe the public markets, focused on silver's fireworks, are completely mispricing the imminent collision of this freight train of demand with a brick wall of supply. Because here is the brutal geological reality. Supply cannot answer this call, not in any meaningful time frame. Bringing a new copper mine from discovery to production now takes, on average, over 13 years. The easy high-grade ore is gone. What's left is deeper, dirtier, and more expensive to process. The mining industry is not built for a sudden demand shock of this magnitude. The proof is in the vanishing inventories. Stockpiles in the London Metal Exchange, the world's buffer, have plummeted. They now stand at roughly a 3-day global supply, but even that number is a dangerous mirage. The vast majority of that metal is of Chinese or Russian origin, and due to sanctions and certification issues, it is not deliverable against contracts for Western companies. For a firm like Amazon building in Arizona, the actually accessible buffer is a tiny fraction of the headline figure, a few thousand tons against annual North American demand in the millions. This is the phantom backstop. It's why AWS went straight to the mine. They looked at the official inventory data and saw a ghost. They realized the market's promise of delivery was an illusion. This leads to the strongest counter-argument, and it's one we must take seriously. What about a recession? If the global economy stumbles, won't industrial demand for copper collapse, breaking this whole thesis? It's a valid point. In a severe, protracted downturn, demand would soften. But this is where the old cyclical playbook fails. The corporate direct deals are the clue. Amazon isn't buying copper because they think the PMI manufacturing index is going up next quarter. They are buying it because their blueprints for next year's data centers require it, full stop. This demand is non-fungible. You can't substitute it or postpone it without forfeiting your competitive edge. A recession might slow the rates of increase, but it does not erase the structural, locked-in trajectory of electrification and AI adoption. Furthermore, a recessionary price drop would have a perverse effect. It would cause mining companies to cancel or delay the very projects needed a decade from now, making the eventual supply crisis even worse. So what happens next? In my view, we are not headed for a dramatic overnight copper moonshot that mirrors a meme stock. We are entering an era of grinding tectonic repricing. I expect copper to chop around, frustrating both bulls and bears, while slowly but inexorably establishing a higher and higher price floor. The $550 per pound level is the key line in the sand. If it holds through the next broad market panic, that will be the market's admission that copper has permanently decoupled from pure cyclicality. Meanwhile, the physical premiums paid in off-market deals will continue to creep above the sterile exchange price, revealing the true cost of guaranteed delivery. The great repricing will be quiet at first, noticed only by supply chain managers and a few observant analysts. The mainstream will remain hypnotized by the volatility of silver and gold. But gradually, the truth will become undeniable. The world is attempting a monumental, energy-intensive technological transition, and it is doing so with a copper cupboard that is nearly bare. The corporations who literally build the future have seen the emptiness first. They are not waiting for CNBC to tell them. They are locking the door and taking the key. Therefore, the silver record is a headline for today, an important one, but a symptom. The copper supply crisis is the story for the next 10 years. It is the story of a world that finally, painfully, realizes that the most critical infrastructure of the digital age cannot be printed, cannot be synthesized, and can no longer be taken for granted. The smart money isn't just buying copper, it's trying to own the very pipes through which it flows. The question is no longer if this metal will be repriced, but when the rest of the world will look up from the glitter of precious metals and notice that the foundation is being sold out from under them.